Well, I think that investors can't wait for this earnings season to begin to get past a little bit of these distractions on whether it be interest rates, Italy, midterm elections, you name it, whatever it might be. They're looking to put that behind them and focus on those earnings. And as everyone knows, we're expecting the third consecutive quarter of more than 20% year-over-year earnings per share growth. And we've seen significant upward revisions in both technology and in healthcare in those sectors. And so I think that there is the opportunity here for a very solid earnings season to help save the markets or help put a kind of some momentum back behind the markets from that standpoint. Now, the thing that I think will be interesting is that one of the things we've observed over the last several quarters is that companies have not been rewarded for beating their earnings as much as they have been in the past.
Yes.
And the punishment for missing has been really severe. So this is something to keep an eye on if that trend continues. So we'll see tomorrow, for example, if those financial companies just merely beat their earnings, is that good enough for investors? The other thing I would keep an eye on is the fact that seeing what corporate executives say about trade and in terms of the future of the market. I think the earnings themselves, they're going to beat the earnings. But I think what they say about future earnings is going to be important. And I do think that, how much are they beating by is going to be important as well.
And as we take stock of the market close, worth pointing out once again that if you slice the S&P 500 into 11 industry groups, energy, financials, real estate, the leading decliners here, financials we bring up, of course, because of the connection to earnings with those big banks reporting on Friday.
Michael, as we look at the close here, one thing that's different about today than some of the recent days is that your bond part of your portfolio is doing very nicely. We saw rates drop across the board. We're talking a lot about stock-bond correlations. Is a healthy bond allocation, in your view, still a strong diversifier?
Well, it has proven to be, at least in the last day or so, right? It looked like 10-year treasuries kind of peaked out at around 323, 324. Last I checked before I came over here to speak with you guys was around 312 or so. So it does seem as though folks are kind of pivoting towards treasuries as a bit of a safe haven in times of higher volatility. There was the discussion around the MOVE index compared to the implied volatility index, the VIX, and how we haven't seen necessarily that volatility come through on the fixed income side. And interestingly enough, although spreads have widened some in terms of credit, they've remained reasonably well behaved, especially compared to equity volatility, most notably from the VIX. So it does appear that still having some portion of a diversified portfolio in fixed income is important. Last thing I'll quickly say on this is what we've been observing from investors is they have been moving up in investment quality, have been moving from a fixed to floating rate, and they've been buying shorter maturities in terms of 1 to 3 years and cash and those types of things, getting a bit more conservative as we've seen interest rates become more volatile.
So short-term debt is a haven that you see in treasuries back in play. What about gold, Michael?
It's been fascinating, and I keep pointing out to my colleagues that folks often continue to talk about gold. Geez, what's the matter with gold? It really hasn't proven to be that safe haven that many were expecting throughout this year. And then look at the last couple days. When most everything is red, what happens with gold? You actually start to see it accelerate. It has that property. Folks talk about it as an inflation hedge. They talk about it as all these different types of things. What I view it as is when correlations are rising, when stocks and bonds are kind of moving together in tandem, and everything seems to be going negative, gold always serves as that kind of fortifier in your portfolio. It either maintains its value or increases in value, and that's what we've observed in the last 2 days with gold.
Yeah, gold up 2.8%, now rising for a third straight day. By the way, the gain today is the biggest since June of 2016. Michael Aroney, State Street Global Advisors Chief Investment Strategist, thank you so much. That does it for the closing bell, and for me. Romaine Bostick is stepping in next for What You Missed, where we'll be looking at U.S. inflation missing estimates for September and the implications of that. This is Bloomberg.